Hi, in today's video you're going to be looking at borrowing money. Alright, so obviously you borrow money if you need to buy something. It's really something you need or something you probably want. Alright, so we know that people are less likely to save for something nowadays than they used to, say 30-40 years ago. Obviously if you could do that, then that's great because you're going to save paying interest and all that sort of stuff. Alright, so obviously the best plan is to save and pay for it rather than borrowing money, but that's not going to happen. Alright, so for a lot of people, so debt itself is not necessarily a bad thing. There are things that are called good debts and bad debts. Alright, so generally when you borrow, we need you to borrow money responsibly, and we need you to invest wisely. Alright, so obviously we want to get that long-term goal of creating wealth and so on. So an example of good debts, okay? So good debts are used for things that you need and things that are going to go up or appreciate. So they're things like house, education, buying a business, medical expenses, buying shares. So bad debts are things that you generally want and they go down or depreciate. And those consumer items, things like TVs, phones, computers, clothes, and other bills and that sort of stuff. Cars certainly fit in halfway there. So some cars will appreciate, a lot of cars will generally go down in value. I've probably used this example before, which is, I've got a deal for you, alright? It only costs you $30,000. As soon as you drive it away, it's worth 20% less, and then you have to pay, $5,000 a year to run it, and then every year it loses $5,000 worth of value. Right? So does that sound like an attractive deal? Well, no, it doesn't. But that's really the reality cost of running a car or buying a car. Now, obviously, some older cars and some, those sort of cars can be, they can actually appreciate because of collectibles. But generally most cars that you have are things that are going to depreciate. Now the problem today is it's actually relatively easy to borrow money, right? Especially when you're 18. Once you've got a job and you can pay it back, it's generally pretty easy to get money. And we generally get money from banks or from agencies through credit cards. You can get a thing called a personal loan, right? They do lines of credit, right? So you can actually have a line of credit. I'll explain that in class. You got a home loan, right? So they're things that you can do. You can get store deals, rent to buy, interest-free periods. You have peer-to-peer lenders, right? And then you also have payday loans. Payday loans are those things like wizard loans and cash train and all those sort of things which are pretty dodgy. Alright, so here's a few questions. So question 27.1, why do people borrow money? Well, you buy money because you need, there are things that you need or you want and you don't actually have the money. So that's why you would borrow the money. So why do people borrow more money today than they did in the past? Well, there's probably lots of reasons for that, but maybe things cost more. Loans are available, we can get loans, and people understand that debt and the TVM. So they actually understand about debt, and generally they understand about what things are in terms of good debts and bad debts. So how does good debt differ from a bad debt? Well, we know a good debt appreciates and a bad debt depreciates. So things like houses, they grow in value over time, where cars they're worth less over time. Alright, so that's the sort of thing we're going down here. Under what conditions are you able to apply for a loan? Well, you have to be 18, you have to have a regular income, and you have to basically show that you have earned some money and you've been able to save money. Alright, so they call it a credit history. You need to try and have a good credit history. That's what you basically do. Alright, so a payday loan is a loan to pay some expenses when you've run out of money. Alright, so working at these payday loans, well, cash converters, Nimblet, Wallet Wizard and all those things are all examples of payday loans. And then I'd like you to actually maybe investigate what a peer-to-peer loan is. All right, so they're sort of examples of another type of lender that you have access to. All right, generally a good rule of thumb, I suppose, is if you can afford to save for your first car, I would probably try and save as much money as I could and not borrow money for my first car. But when you want to buy your first really good car, you might not be able to afford to do that. So that's when you'll go for maybe a personal loan, and you can generally get a better loan from a bank than you can from a finance company. Again, it's about looking at all the options and weighing up and understanding how to calculate how much you're paying for it, and then making a decision based on that information. All right? That's about using your understanding of money, which is really important.